Well, hello everybody. This is a new type of video when I shall be using the whiteboard behind me, into which I will zoom the camera focus in a minute to try and explain some concepts in some short training videos or refresher videos. The topics being ones that I have picked from a list of requests from subscribers. Today's topic will be portfolio maintenance. What do you need to do to keep on top of your portfolio after you've built it? Clearly, I think everybody listening to this video will already have a portfolio, and I've written extensively on the need to keep track of the news to see how changes in the world might impact on the performance of your investments and if there's any requirement to alter the asset mix. So let's jump right in. I'll zoom in on the screen. You'll see that I've divided the screen into two sections. Here we have monitoring and here we have review. And I've given you a clue as to what I'm talking about and what might distinguish the two by writing this question: how often? In my opinion, people should monitor their portfolios on a continuous basis in terms of being prepared to go and have a look at what's happening if they think something in the world has changed. However, most people will want to look at the valuation. That will be their first measure. Has it gone up? Has it gone down? In the very short term, that's not particularly useful. So although we might be interested in that on a weekly basis, I think that the shortest time period over which one should actively look at the portfolio data with a view to taking some actions is probably once a month. So I think monitoring is a monthly look at the portfolio. And a review is a much more comprehensive look with more data to hand and a greater likelihood of having to take some strategic decisions about asset allocation. A formal review is the sort of thing that an IFA would be doing if you were paying for ongoing service, or at least they should be doing. And I mentioned there that St James's Place, that legendary outfit that takes people's money for doing very little, has just been penalised by the regulators for taking ongoing service fees and doing nothing for 3 years to engage with the client and suggest changes to their portfolio. So I think half yearly is appropriate for reviews. Put that on. Now, I briefly introduced a purpose, which is the next label I put on the chart here. The reason we might review the portfolio is going to be a lot to do with the fact that the world changes. It's just changed an awful lot with the inauguration of Donald Trump. That's not going to happen very often. That exact event probably won't happen for another 4 years. But we need to be aware that there might be surprises. There might be black swans, there might be unknown unknowns that have suddenly become known. So one of the reasons for monitoring your portfolio is to check for surprises. Maybe a fund is performing a lot less well than you thought. Perhaps the fund manager's left. You wouldn't necessarily know that. You're not like me reading 2 or 3 trade newspapers output every day. So you might want to investigate why a fund is suddenly doing badly. Second, and I think this is a very important reason for looking at your portfolio regularly, is to take profits. And you might do that for fear of losing them if the market turns against you. You're not likely to be able to make judgments on that month to month, to be honest. But on the other hand, if you want money to spend, you may need to take profits several times a year. And as any farmer will tell you, you can only milk a cow at a certain time of day. You can't randomly decide to milk the cow or at least not a herd of cows. You have to have a schedule and look to take your returns on a regular basis. The third reason you might perhaps once a month want to look at the portfolio is because you have noted a significant change in the macro climate. For example, interest rates have moved in a way that wasn't expected previously by the market. That will have an impact on your fixed income investments if you have any, or any decision about the weighting of fixed income investments you have in the portfolio. So I think I'll call that macro changes. What information do you need? What resources will you have to hand to complete this sort of monthly review light, if we can call it that, a monitoring exercise? Well, you need evaluation. That will need to show you the funds you've got, the returns you've made to date. And I suggest that if you have access to it, it will be useful to have a Morningstar X-ray because that provides a lot of additional data. How you use a Morningstar X-ray is something covered in considerable detail in a written article on the website under the How To tab, where a lot of the important permanent content that I've written is included. Moving on to the more comprehensive half-yearly review, you're going to consider the same potential factors as on the left: any surprises, the need to take profits, and any changes in the macro climate. But I suggest you'll also want to check in some detail individual fund performance. So we'll put this as extras. That will be the performance of the funds in absolute terms, plus or minus, any large changes in either direction being significant, but particularly relative to other funds in the same peer group. Is your fund proving to be the good one you thought it was when you chose it? You must have done research. You must have decided this was probably the right fund. After all, none of us can know the future, so we're looking for a suitable fund. Is it still suitable, or is it beginning to look inappropriate? You'll need information about performance over the last year, probably to compare 3-year performance, and I suggest you'll need to check the volatility. You'll also need to look at the asset mix of your portfolio, because that will change. As good funds do well, they take up more of the asset mix. As bad funds do badly, clearly they're less of the asset mix. If you own multi-asset funds, they'll rebalance automatically. Sometimes a good thing. The funds that have done badly will have more new money allocated to them, or profits from the good funds used to buy the now cheaper bad funds. That might be a strategy you adopt, but I suggest you'll probably take a more intelligent view. Human intelligence, in my judgment, is still massively superior to the artificial type. It really helps if you've got a target asset mix already set up. If you're way out of line with that, you might want to say, is the target still correct? Maybe it's not. If it is still correct and you're out of line, you need to make transactions to try and bring the portfolio back in line with the target asset mix. I always emphasize that people ought to be aware why they're investing their money and what they expect to get from the portfolio. What are their objectives? I think those need rechecking because our lives change. We might have moved house. We might have sold a major asset like a second property, a boat. We might have actually just made a lot of money and find we've got more money than we need to meet our objectives, and we can add some extra objectives. Very nice. Underlying all this is the famous statement by John Maynard Keynes when he was criticised for making a proposal that was rather different to what he'd said before, apparently from a woman, because the quotation always goes, "When the facts change, madam, I change my mind." The resources we need are these same resources of evaluation, but I suggest we need valuation and an x-ray, but I suggest we need some sort of additional paperwork. For most people that will mean using a computer and using Excel because that's the perfect tool, and having some sort of ready-made spreadsheet template that allows us to update fund performance information, relative performance, look at some charts and so on. I have templates available. Some of you are already using those, varying from quite simple to extremely sophisticated, requiring downloads of data from your dealing platform. I'll show you some examples. You can tell I'm doing this for the first time. You won't be able to see the detail of the Morningstar X-ray on the screen, and you don't need to, but what I would point out is the way Morningstar X-rays are divided into these blocks by these black headings, and my explanation as to how to use this data works through these stripes, what the headings mean, and which ones are really important, because there's a lot of information there and you don't really need to pay much attention to all of it. Definitely going to need to practice this. What I put up there are extracts from the Comprehensive Portfolio Review Workbook that was developed with one of my subscribers, one of your fellow investors, showing the sort of information that you can have to hand if you're prepared to spend a little bit of time understanding a reasonably comprehensive Excel workbook and downloading the relevant data on a regular basis. Here we have a list of asset types and asset spread. It says there, I'll read it for you: equities, fixed income, real estate, absolute return, commodities and cash. And there's a percentage target that the particular investor thinks is appropriate for their objectives, probably set up in consultation with me to offer some general guidance as to how this should be done, not recommendations of course. And then on the right is automatically calculated where this particular portfolio sits. Where those boxes, you might just be able to see a pink, it means it's out of line with the targets. Most of the time you will be out of line with a specific target. It's a question of how much and why. Underneath are data, in this case for a pension, that's what's on the right, that would be if there was an ISA. And here are more specific logical targets, logical sector targets, for example, cash, absolute return, emerging markets, Europe, fixed income, UK growth and so on. And there are more detailed granular targets, and here is a comparison with black figures showing over target and red figures showing under target. Very useful to see that if you're thinking about taking profits or if you have new money to invest. On the right, this is an extract of a performance report out of the same workbook. These charts, ring donut, show percentages of funds by each colour block in each peer group quartile over 1 and 3 years. The middle chart shows volatility spread across very low, low, medium, high and very high. You can see this portfolio, that tall block, if you can see it, is medium risk in the main. And to the right, this particular investor is interested in sustainability, so there's an assessment of where their funds sit in terms of Morningstar sustainability globes. The underlying data is shown underneath. The workbook allows you to filter this with switches, so if you think, well, I've got some funds in quartile 4 over 1 year, you can click a button and find out what those funds are. Very, very useful, and I recommend everybody develop something like that to suit their own personal ability level and requirements. Hopefully that's useful. This is the first and therefore a bit clunky of these videos, and I bend down to get into shot and say thanks for watching.